this woman, Tiffany Gianzi, and I'm just going to play a little bit of it, and then I'm bringing my my expert to debunk this. So here, let's watch a little. Here we go.
Last night, I started off by researching Hooters getting bankrupted by private equity and ended up uncovering the next 2008 level economic collapse. And they're hiding the bubble inside a private equity black box that makes it almost impossible to see what they're doing. Almost. This time, they're not going to collapse the banks and make it too big to fail. They're going to bankrupt the entire American pension system. I'm almost too afraid to make this video, but it has to be done, so let's get into it. In 2008, investors and bankers were able to crash the world's economy by engaging in risky, unethical bets and investments, and they did it right out in the open. They've learned, and this time they're doing it again. Bigger investments, bigger risks, same playbook, but they're doing it behind the smokescreen of private equity in bigger numbers. They're creating a bigger bubble than before, and it's not somewhere down the road. It's here, and it's about to pop. You see, for the last month, I've been trying to figure out why these companies that private equity had acquired were failing even though they were still succeeding. Joann's, 97% of their stores are still profitable, and yet they're still bankrupt. But they weren't bankrupt a year ago, and they still had the debt that private equity had stacked on them a year ago. So I wanted to know what changed. The same thing with Hooters. The same thing with... Now, in 2024, private equity bankrupted 110 businesses. And that was almost double their previous record. There had been huge increases in the amount of bankruptcies each year over the past 3 years. But I didn't know what had changed because private equity had held many of these businesses for several years and they were still succeeding. Until I got my hands on an economic report and an article and found a term that nobody could explain to me. The term was back floating rate loans. I didn't know what that meant and no article would explain it to me. So I had to go and do research in the financial prospectuses of a bunch of financial investment firms. Guys, in the last few years, private equity has taken out $3.8 trillion in adjustable rate loans. These are adjustable rate loans. These private equity firms took out adjustable rate loans. And so for the last 3 years, as our interest rates have gone up, every 30 to 60 days, the money due on the loans they stacked on top of these companies has gone up every 30 to 60 days. That's why these successful companies that private equity had acquired are suddenly bankrupt, even though they're still making money. They're bankrupt because they're paying adjustable rate loans. But it doesn't stop there. It gets so much worse because my next question is, why are the banks willing to give these risky loans to these private equity firms knowing it's going to cause them to fail? And the answer is because the banks aren't going to keep them on their books. The banks are immediately repackaging these adjustable rate loans as something called CLOs, right? Which are then packaged and sold off to our pension funds as really great debt. And they tell them that it's a diversified portfolio. Are you hearing The Big Short in real time? Literally, all of these companies are getting bankrupted in greater and greater numbers. And all of this debt is adjustable rate. And all of the bankruptcies are skyrocketing in this direction. And now if you look at this...
So let me bring in our financial expert, Carol Roth, back to the show. She's, of course, an American television personality. We all know her from the TV. So Mark Burnett's America's Greatest Makers television show. She's a weekly panelist on current events at Business Show, Bulls and Bears. She's a best-selling author, New York Times best-selling author of The Entrepreneur Equation. Her latest book is You Will Own Nothing, Your War with a New Financial World Order and How to Fight Back. Welcome back to the show, Carol Roth. Hi, Carol.
Hi, Jimmy. Always great to see you.
So where do you want to start with that?
All right, so I think I want to start with just some of my background, and then we can kind of get into the video because I think it's important. First, disclaimers that I have been in the financial industry on and off for a very long time, and so I have had many personal and professional experiences with private equity, some very good and some bad. Some of the greediest twats that I've ever met in my life have been in private equity, but I've also had great experiences and worked with private equity firms evaluating deals. So just wanted to throw that out there so that you can kind of make the decisions for yourself. As people know, Jimmy, who've seen me before on the show, I'm a small business advocate as well. And I think that what you need to know about private equity first before we get into the video is that they definitely have some issues and some problems. And there are certainly some companies that are worse and some that are better. And so I think it's important for us to, not discuss it as one class of things. Some companies do a great job and some don't. So we have to kind of differentiate that. The reason that private equity has become such a big deal is because it has become harder for companies to go public. There has been a bigger bar, it's been more expensive, and there's been more regulation since the Sarbanes-Oxley requirements many years ago. And so not as many companies have that as an option. So a private equity firm is going to come in to different companies, and depending on the focus of the firm, they're either going to provide capital to grow the business, they're going to provide the founders and investors a way to exit their business and create a liquidity event. And sometimes some private equity firms buy distressed businesses that have run into trouble for all different kinds of reasons. So I think it's important to know that private equity in general, their investments are riskier than public investments because there is no public scrutiny. Some of them do take on this distressed type of business. And so for that, because they are taking on more risk, they demand a higher return, and there's also going to be more failures. So that kind of creates some of the backdrops. This video, I was tagged in probably 100 times if I was tagged in once on X. And it's a video that, on one part of me, I'm really glad people are out there doing research and trying to learn things. But it's also somewhat frustrating when people don't reach out to experts, because just because they discovered something one day doesn't mean that it's not something that has existed for a long time. And when you start taking different pieces of information, you don't really understand the full picture, they create a conflation of issues. So what I do like about the video is that there are some really legitimate issues that have been floated that I think we should talk about, but it's not necessarily always the cause and effect that was brought up in the video, if that makes sense to you.
Yeah. So let's start here. So she says, what if I told you Jones, which is the fabric store, has Joann's, is that how you say it?
Joann's,
okay.
yeah.
Well, I'm a fella, so I don't know about that. So Joann's has 97% of its stores still profitable. Hooters, I know about that, I can pronounce that one. Hooters was making money, Party City, cash positive stores, and yet they're all going bankrupt. And she says, why? Well, because private equity is using a weaponized version of the 2008 playbook. So why are they, if they're profitable, why are those stores going bankrupt?
So this is where we'd have to actually go into each one of these companies to kind of go through the specific issues that impacted them. With Party City, they've been through bankruptcy multiple times. They emerged. There was a helium shortage, which impacted their ability to sell balloons. I mean, there's all kinds of things going on. When Joann's did go into bankruptcy, I believe it was maybe the first time, but back in March 2024 in their disclosures, they did say that 96% of their stores were profitable. Now, profitable does, first of all, a lot of heavy lifting, because we don't necessarily know if that means they made a penny or they made, a very good margin. What we do know is that in the time period while they were going through their different processes, that a lot of these businesses deteriorated. Now, yes, for many of the examples that she has put up, there is way too much debt that was put on this business, these businesses, because for something like Joann's, they had done really, really well during the COVID shutdown when there was all the crafting, and so the assumption probably was, oh, this is going to be the level of business going forward, and then obviously things shifted. But the idea that all of a sudden retail is just going out of business because of private equity, we know, think about, Jimmy, all of the retailers from our childhood, the Ventures, the Turnstiles, the Kmarts, the Woolworths, the names go on, and restaurants as well that have gone under. So that is not that the retail cycle goes through a lot of shifts. It's not unusual. If anybody looks at the mall landscape, you can see that there's, it's just been decimated. So when you have the issue of a lot of debt on a business, and then something changes in that business, the projections, then yes, you do end up in a situation where some of these go out of business, and that is absolutely the fault of the private equity firm. But certainly, especially with these high-end examples, this is not the intention, and the companies do not make the returns that they're looking for, the money that they're looking for by doing this. So I do not think we would say they're intentionally trying to do this. Is it risky? Is it too much debt? Absolutely. And so that's where I think, we need a part and parcel where, yes, she's making a very valid point in one regard, but then trying to connect it with other issues.
So tell me so I barely even understand what it means what private equity even means, right?
Yeah.
So a private equity firm, how would you define what a private equity firm is?
So a private equity firm is a firm that brings together a bunch of capital, and they have it under their management to go out and to invest in other businesses. And they may buy either a minority stake, where they own a piece of the business, but they're not the majority owner, what you would consider the owner of the business. But most private equity firms like to be the majority owner. So whoever was the previous owner, maybe the founder, maybe other investors, that they use their money to go in and make an investment. Some of that money could go to buying out other investors and founders and things like that. And some of the money that they put up goes to hopefully improve the business. Not always the case. Some of this is just financial engineering, but hopefully to create a growth plan for the business. In addition to that money that they've raised, then they look for debt. And it's usually from a lot of different sources. It can be from a bank, it can be from mezzanine lenders, it can be from private credit lenders, all different kinds of debt that they put on the business as well. And usually if they're looking at a business that has a lot of cash flow, then they can say, oh, okay, this business can predictably pay down this debt over time. And because that gets paid down, our equity becomes more valuable. And that's this whole point of why they're putting the debt on the business, is because they're trying to create a higher return from their best investors that gave them the equity capital that has ownership in the business. Equity owns the business. The debt has a claim on the business depending on where it is in the capital structure. Does that make sense?
Yes, so a private equity firm is just a group of investors that go out and buy majority stock or majority ownership in companies, and then often they will then borrow more money to theoretically invest into that business to make it more profitable, correct?
Sometimes, or again, to juice their returns, and that's the push-pull here. Some of the private equity firms have processes. So if you have a smaller company that they're buying, they may say, you don't have professional management. We're going to help you put in management. We're going to help you professionalize, put in systems, put in better accounting controls and things, better ideas to grow your business. When you get to big companies, when you're talking about the Joannes of the world and the Party Cities, it's probably less of that and more of the financial engineering. And I think that's where, they get the bad rap from.
So help me explain, how does a private equity firm juice their returns by borrowing money and saddling the company they just bought a majority stake in? But how does that turn into more money for the private equity firm by accumulating debt for the company they just bought?
Sure. So let's say we have a company, I'm just going to use made up numbers to make it easy, but let's say we have a company that we need to buy for $100 million. Are you in with me, Jimmy? We're going to go, you and I, we're going to go buy it for $100 million. Let's say we got all of our friends together and we had $100 million and we used this equity. We're all going to get ownership, and we bought it for $100 million, and then it turns into $200 million. We've taken our $100 million and turned it into $200, so we've doubled that.
How do we turn it into $200 million?
we have a growth plan, the business grows, it's been growing at 30% a year. We tell them, hey, you should have an all-you-can-eat buffet. It's going to bring in more customers, all the businessy kinds of stuff.
Okay.
And it's already been growing on a trajectory of that. So we know in 5 to 7 years that's our projection.
So,
let's just say,
the projection is it'll be 200 million.
200 million. So we're going to take our 100 that we have, our money, our equity, and own it. And we're going to say when it's 200, everybody doubled their money. But I have a better idea, Jimmy. What if we just put in 50 million and then we borrowed 50 from the bank? And then we have 100 million. And this company, we're going to use every time they make a profit, that we're going to use that cash to pay down the debt. And by the time we sell this business in 7 years, we're going to pay off all of that debt. And now our 50 million is worth 200 million. So instead of doubling our money, we now have a 4 times multiple of our money. So you can see why that is an attractive proposition, and that is the financial engineering that goes in with these things like leverage buyouts and private equity buyouts, where they're using debt to increase the return on the equity. Does that make sense?
Yes, now I get it. Okay, so you'll get a bigger return because you're actually putting less up front.
Yes.
You're going to get a bigger return on the money you initially invested. The money that you're using to buy the business is borrowed. It's debt.
It's borrowed. And let's just say even let's say we didn't pay any of it down. We still now we put in 50 and we have to pay back that 50 million off our 200. We still have $150 million worth of value. And so it's still tripled even if we didn't pay down a cent of that debt.
Okay.
So the more we can pay down from the cash flow of the business, it will increase our returns. But even so, in that particular example, that worked. Now, this is where financial firms model it out because they have to make sure the business grows. They have to make sure they get a certain return. They have to make sure all these things align. And this is where the miscalculation has happened when they put on too much debt and the company doesn't make enough money to be able to pay down that debt. And that's where they end up running into trouble and sometimes head into a bankruptcy, which, your viewers, sometimes people on the street, they may think, oh, when you're bankrupt, that means you didn't make any money, or you're out of business, or whatever it is. But the Chapter 11 process is specifically for for companies that get into this financial trouble where they have too much debt, and it gives them an opportunity to continue to run and operate the business and see if they can come to an agreement with the debt holders. And then the equity holders, us who put up the money, usually get wiped out, and the new buyer ends up then helping to pay back that debt. So that's what happens when they go through bankruptcy. If they can't find a new buyer to step in and do that, then they end up having to liquidate the business. But that's one of the issues I have with this, is to the extent there's still a viable business that is, that is really doing well, somebody else is going to come out and they are going to repurchase that business, wipe out the equity holders. The debt holders may not be made whole. They may only get 50 cents on the dollar or 75% of the dollar, but then that business is going to, continue on. And so bankruptcy doesn't mean that it will go out of business until the point that there is no buyer, and particularly if the business is struggling, then they usually go through some sort of a liquidation process.
But sometimes private equity firms buy a majority stakeholder in a business. And do they purposely make the business fail? I am thinking about, for instance, Red Lobster, right? So Red Lobster, correct me if I'm wrong, they owned the property where the Red Lobster was. And what the private equity firm did was they sold the property. And so that kind of bankrupted their business. Am I wrong? Tell me, do you know what happened with Red Lobster?
So I can do some research. I'm happy to come back and talk specifically about Red Lobster. But so one of the things that will happen, and again, it depends on the firm. Some private equity firms are more growth oriented. Some are what this is called fight. Everybody's going to be angry about the financial engineering stuff. But they may say, okay, well, instead of us going to get all of this debt from the bank, what's a different way we can go about doing this? Well, if, we own these properties, what we can do is something called a sale leaseback. So we'll sell the properties and we'll take that cash and we'll use that either to run the business, pay down the debt, supplement, how much we're paying, whatever it is. And then the people who, whether it's the franchisees or company-owned stores, now you have to pay rent to a landlord, on a monthly basis instead of just owning the building. And so that is a perfectly legitimate strategy that works sometimes it doesn't. It really does depend on the specific situation, and I don't know enough about Red Lobster to be able to speak exactly to that. I do think my joke about the all you can eat buffet, that was one of the things I think that made them go sideways. But the miscalculation does come in when the private equity firm thinks they can put a lot of debt on, and they get really aggressive with that, and then the business doesn't perform as well as they had projected, and that's where that disconnect happens. In terms of your question of do they do this on purpose, there are definitely firms that are called, vulture capital and bad actors. But the big name companies, the companies like the Leonard Greens who are involved with Joann's, their entire business model is based on being really successful with these, because they can't go out and raise more money for their next fund from investors if they're not doing a good job. What happens in a portfolio strategy is that some of them are going to work and some of them are going to not work. And so the winners, if those overtake the losers, they tend to not care as much because it matters about the total return for them. And obviously that's something that matters to customers, to people who work there. And so I'm not saying it's a right thing. I'm just trying to give you a sense of the mindset. But the intention of going in, they make the big bucks because they participate in the upside that we were talking about. That $50 or $100 million we were talking about putting in, they get 20% of whatever it is, or not all of them are 20, but that's kind of the industry standard. But they get a big percentage of the upside of when they go and they sell the business to the next person, or they take it public. So that doesn't bode well for them if all of a sudden they have a whole bunch of bankrupt businesses in their portfolio.
So what about this new term sheet discovered? So in 2008, we all know or remember what happened was that they were having these adjustable mortgages.
Yes.
And so when it was at 3%, everybody could make their payments, but when it went up to 7%, people couldn't make their payments anymore, and they had to default on their loans, and we had a housing crash.
Right.
Now, she's saying that they're doing a similar thing where they're getting these loans for these businesses on a new term for an adjustable mortgage, and that now that they're going up, they can't pay they can't make their mortgage payments or whatever the debt payment is. And
Yeah,
so, and then they're go ahead.
This is where the confusion. So, adjustable rate lending, if you have a loan from a bank in your corporation, it's something like 85% of all loans are adjustable rates, have been for, forever. Like that's the lending. Basically, they're lending at something called SOFR, the Secured Overnight Financing Rate, which is how banks lend to each other. The standard used to be LIBOR, but it's now SOFR, plus a series of basis points, because the banks don't want to be caught in an issue, like you said, if the interest rate goes up. They don't want to say, oh my God, now we're here and our loans don't make any sense. So they usually end up at SOFR plus some amount. So that is 100% for loans. If you get a bond, if you get some other type of financing in your financing structure, you may be able to get some high rate fixed debt, but the loans is the majority. And I can post on my X feed if it's helpful, from the Fed, where you can see adjustable rate loans versus fixed rate loans for corporate financing. So bonds are usually fixed rate and loans are usually adjustable. Now, what she's talking about in terms of loans is something called CLOs, collateralized loan obligations. And this does ring very similar to the great financial crisis. So I understand why like that set off alarm bells. And this comes around like every 5 years somebody writes an article, but they actually started creating CLOs in the late 80s or early 90s. So this is not new. If the banks can financialize and package anything, they're going to do it. They are riskier loans. So, worse rated corporate debt, as well as some of this like leverage buyout debt, gets packaged together and it gets sold off. It's fairly well known, even though the rating agencies are involved, and obviously they probably give them better ratings than they should, as we know their history. But it's fairly well known that these are riskier products. So that is not something where they're being told like, oh, this is something that's really safe. Like if you're investing this as an investor, an institutional investor, you should know that a CLO is made up of riskier loans, and for that they're getting a higher return. So that's part of the issue here. Now she brought up an important issue, which is that these are being sold to things like pension funds. And
so before we get to that, so
okay.
Back in the 2008, what a big part of that problem was, they would take these riskier loans, these subprime mortgages,
Yes.
and they would have a rating agency rate them as
Correct.
AAA or whatever the rating was,
Yes.
saying they're excellent. That's not happening now, right?
So yeah, as I said, the rating agencies probably are overrating them better, but they're still known to be risky. So it's like, okay, it's really risky, and they're probably telling people that they're just kind of risky. The default rates have increased, but not substantially. It's not a product so far that has had a huge default rate, which doesn't mean that in the future it won't. But the big issue, just to make it clear, in the Great Financial Crisis, Great Recession financial crisis, was the reason why that was such a big, horrible scenario was not just because of these CDOs instead of CLOs, the collateralized debt obligations, but because of the insurance sold against it, something called a credit default swap. And basically what happened was, for every mortgage, let's say, that's out there, they insured that some exponential amount of times. I don't know if it was 3, 5, 10, or 100. But so basically every time something failed, like a whole slew of people were collecting on that multiple times. So the size of the failure ended up being exponentially bigger than the size of the industry. What I would be scared about here is if we hear on collateralized loan obligations or any other product, commercial real estate or something, if they start with these credit default swaps and selling massive insurance that is exponentially bigger, that takes something that would have been a small, manageable, recession and turns it into a giant crisis. That was like, you had the flame and it just, threw the match and the gas on there and went with it.
So what they do is they have this loan, and then they sell insurance, and if this loan defaults, somebody will collect on that.
And they sell it to multiple people on the same loan. So they sell it to you, and they sell it to Kurt, and they sell it to Misha, and they sell it to whatever, all on the same loan. So it's not just one person collecting when it goes bad. It's like a whole group of people collecting, and that's why you take something that would have been bad and you make it hugely bad.
It's not actually insurance. It's more of a bet, right? It's like a short.
Yeah, it's a insurance type product, which is why AIG was the one who ended up having the biggest role in it. So it's called a credit default swap. They could come up with another cute name, but that's the issue: is do we take something that we have and do we find a derivative product that makes it 3, 5, 10, 100 times worse? So that's the smoking gun.
Yeah. So now, are they doing this with this corporate debt? Are they now repackaging it and selling this debt off to pension funds, and then pension funds are all going to crash now? Because that's what she made it sound like in that video.
Yeah. So that's the issue. And as I said, I think let's put it this way. There's a lot of money in these collateralized loan obligations. It's like 1.2 trillion, I think, at the last time I checked. So there's a lot of money in these risky situations. Not every piece of debt in it is private equity backed. Not every piece of private equity backed debt is something that's going through bankruptcy. But it is something to keep an eye on. But it's not any bigger in scope than the amount of credit card debt that we have, which is also adjustable rate, as we've talked about. Commercial real estate is 2 times the size of this. And the biggest issue, Jimmy, which I actually wrote about in You Will Own Nothing, is the research I did then was from 2021, and a group called ALEC. They estimated the underfunding of pensions, the liability there at the state level, so state pensions, teachers' pensions and the like, at that point was $8.2 trillion, and that was in 2021. And you can imagine that it's gotten worse since then. And on top of that, that these pension funds, in order to meet their obligations and also juice their own returns, pension funds were taking on debt, not investing in debt, not investing in these products, but taking on debt in order to be able to service their portfolio. So I think a pension crisis is 100% on the table, and I think that's one of the great things that Tiffany brought to light here. But is it really going to be private equity and CLOs that tip it in? It's not impossible, but it may be one of a slew of things, but more likely some of these other issues are going to be the bigger issues for pensions, including just the general level of underfunding.
Okay, so there's one more thing I want to ask you about before. So she says Trump wants to close the loophole that makes this kind of stuff possible. The entire scam relies on a rigged tax code called the carried interest loophole. Private equity firms get taxed less than teachers and firefighters. This was the Mitt Romney example, that his secretary pays a higher tax rate than he does. Trump says he was going to close this. So tell people, what is the carried interest loophole?
Okay. So first of all, anytime the word loophole is up there, it's part of the tax code. So this is the legal way that the tax code is written. And yes, it does favor folks who are in the private equity community. And this is their rationale. I'm just explaining it. I'm not giving you should agree with it or disagree with it. So it's just the explanation. So basically, the way that private equity firms get paid is they get a management fee on their assets under management, and then they get carried interest. So as I was talking about, a management fee is, Jimmy, you and I, we open up our private equity fund, we get $100 million from a bunch of people, and we get a percentage of that. Why do we get a percentage of that? Well, because we have operations. We have people who need to run financial models. We need to find deals. We have legal expenses to close deals. We're going to put in our own processes. And for our work as private equity professionals, whether you think that work is valuable or not, they get paid a fee, and that is a guaranteed fee. Usually it starts at 2%, but if it's a bigger fund, it tends to go down with the amount of assets that they have under management. Now, the carried interest piece is the other piece of their compensation that we talked about, that basically they're getting the equivalent of equity in the deal. So instead of us saying, okay, we're going to invest this $100 million and we're going to get shares equal to this amount, we just basically say, hey, when this gets sold, if it makes a profit, we get 20% of the upside. It's like an equity proxy. So if we went out and bought stock and that stock went up in value, because there's that risk involved, it gets. The reason why people are upset with private equity getting the same benefits, even though there's risk involved, is that they didn't necessarily make the investment with their own dollars that were already taxed. And so that upside that they're getting is being taxed at a capital gains rate instead of an ordinary income rate, and that's what's called the carried interest loophole. And it does, and that's another reason. So she's sort of contradicting herself. that obviously if they want to benefit from carried interest, they wouldn't be bankrupting businesses. They would be making them as successful as possible to try to get more of their compensation at the lower tax rate. One of the great ways to do away with this is to make everything a flat rate. Let's give us all 15% on everything. It doesn't matter what it is, and then we don't have to worry about this nonsense. But because the tax code is so complicated and everyone has their lobbying, and of course the wealthy people are going to lobby for this, this is something that a lot of people think is unfair, and so it has been a really big hot button issue.
Okay, so, all right. I hope that, so that was very helpful for me to understand, because I didn't understand anything. And so now I understand it a little better. I hope the people watching this understand it. And so when the carried interest, so for whatever reason, when you buy a stock and that stock increases in value, the money you make off that stock, you pay the capital, it's called a capital gain. The money you invest is called capital. And then the money that you make off a stock is called a capital gain. And
or
then
if you lose money, it would be a capital loss.
Or a capital loss.
Right.
And you're taxed at a lower rate, capital gain, than or as Mitt Romney's secretary. So they somehow have rigged the tax code. So when you invest money and you make money investing, you're taxed at a lower rate than, say, a person who's just a regular worker. And people are upset about that for obvious reasons.
And let me just explain that, because there is an actual reason. So if let's say you and I go out and we make money, right, doing our jobs, you're doing your job, I'm doing my job, and then we take that money and we invest in a stock, we're putting it at risk. So it could go up or it could go down, and that money that we're putting in the stock's already been taxed. It was taxed from our income. So when you and I make that investment, this is after tax dollars that we're putting to work in an investment, and we're taking on risk. And so for both of those reasons, that's why, and this, the same thing goes with, anybody who's investing in the stock market. It's not just wealthy people. The issue specifically is the carrying over that to private equity, because they are not using after tax dollars.
Right.
They are taking on risk, and so one of those elements is missing, and so that creates an issue that perhaps is more unfair. But compensating people for taking risk, and also for things that have already been taxed and the government's already gotten their greedy little hands on, it does actually make sense.
Okay. Well, I appreciate you explaining that to us. And so should any of us be worrying that the pension funds are going to crash, and should I stay up night worrying about this? Or
I mean, I think we should. It's definitely we should be worried about the entire financial system crashing. I mean, we have 120+% debt to GDP. We're running wartime deficits. Our pensions are underfunded. Like, this system is on its last leg. So it's definitely something that is of great concern. And I think it's why we're seeing very, things that we might consider strange out of the current administration, because they only have so many maneuvers that they can make to try to right this ship. And at every time they try to do it, there's a new roadblock. So I do think it's a concern. It may not, it's, as I said, that the Alliance, it's not necessarily private equity that's going to be the thing that tips it off, but just the fact that our pension funds at the state level are unfunded by tens of trillions. The same thing with all of our promises, Social Security, Medicare, Medicaid. There's a reckoning that needs to be had, and unfortunately, the middle and working class, have been getting screwed, and we need to make that right.
But they're not going to. My prediction, and I'm not a financial person, but I do know, human nature. And my prediction is that the Trump administration is not going to cut the budget. They're not going to balance the budget. In fact, the budget that Donald Trump just pushed through Congress, the continuing resolution, increased the deficit and actually increased the Pentagon spending. So all this DOGE cutting that they're doing is just window dressing, because behind the curtain, they're actually making the problem worse. Correct?
Yeah, I think it's a valid concern. It's also a valid concern that I have, that if they do end up cutting through Doge, and we're seeing issues like now where the stock market is going down and people are feeling less certain, that means the government's probably going to take in less revenue. Right, we took in almost $5 trillion. Part of that's from the stock market, those capital gains taxes we're talking about, and all those things. When it comes down, they'll end up taking in less revenue. So even if Doge makes cuts, we could end up widening the deficit. And in that particular case, based on our debt levels and our deficits, we could end up in a debt spiral. So I would not be surprised, Jimmy, if we see something very out of the box this year, some sort of an agreement to change the value of the dollar or revaluation of gold, like some very out of the box things, because they really are left without options. And as you said, the political will to actually do these things, may not be there. And even if they do, they still may get tripped up because of the fragility of the situation. So that's I share your concerns there.
Yeah, the weapons manufacturers and the military-industrial complex has a stranglehold on the purse strings of our government, and you'd have to, that's where you have to cut. Even Steve Bannon said that on our show. If you're serious, you have to go across the Potomac and you have to make those cuts. They're not going to make those cuts, and I predict they will continue to money print, and they will continue to devalue the dollar.
You and I agree with that. There's only so many release valves, and the most unfortunately palatable one politically is devaluing the dollar, because most people don't understand the difference between a dollar and a dollar's purchasing power. So I think that's the reality, and is why, one of the reasons why when I've come on the show before, I've talked about hedging with gold if you have the opportunity, which has now again hit all-time highs, and doing things to try to protect yourself and to be well diversified as much as possible. And I know for a lot of people, they're just struggling to get by and don't have that opportunity. So, hopefully we'll get the right path, but it's going to be a tough one to get through, and I'm sure we'll be chatting about it again.
Yes. Well, here's the book. You will own nothing. Here it is, by Carol Roth, bestseller. Everybody check it out. Carol, thanks for coming on and explaining stuff to us. Thanks for taking time. It's always great to talk with you.
Yeah, of course. And I would just offer up, if anybody has questions, feel free to reach out. And I also do an economic newsletter that explains these things at carolroth.com/news, which is free. So always happy to help break it down. So thanks for the time, Jimmy.
Okay, fantastic.